Hello and welcome. I'm Silas Parker, Principal Advisor at Silas Parker & Associates. So glad you could tune in for this market update here for January 2024. Today, I'd like to welcome to this session here one of our good friends, Mr. Roman Samuels. Hi, Roman. How are you?
Silas, I'm good. Oh, thank you.
Yeah, we got the live
Thank you.
studio audience here today. Thank you.
Thank you.
So good to be with you, Roman.
Thank you.
Well, Roman, without further ado, let's go ahead and dive in. I know that everybody's eager to know what happened in the market in the last quarter, and what are some of the things that Russell Investments is looking at coming forward that might impact financial markets.
Absolutely. So thank you, everyone. I'm going to go through what we put out every quarter is our economic and market review. This are some trends and insights that Russell Investments puts together every quarter. And we're going to touch on what's going on in the economy, what's going on in the markets, and then furthermore, how can you as an investor benefit from some of this information? So let's go ahead and start off by quickly looking at a year in review. So this is 2023, the last 12 months that we've just gone through. And the blue line that you're seeing is what happened to the stock market. If you'd put $100 into the stock market in January of last year, by the end of last year, your $100 would be worth $126. You'd be up 26% on your money. If you had put same $100 into the bond market, the US bond markets, that's in the orange line. Your $100 by the end of the year would be worth 105. You'd be up 5.5% in your bond portfolio. This is always a great place to start the conversation every January, is by taking a quick look back at what happened. Now, around this chart, you're going to see a number of different boxes that are pointing to a lot of negative, maybe not all negative, but just news that hit headlines throughout those months. And I want to draw a couple things to your attention. First, take a look in that top left-hand corner, the March-April timeframe. March of last year, we saw the collapse of Silicon Valley Bank, Silvergate Bank, and Signature Bank. And then we saw UBS agreed to buy Credit Suisse because Credit Suisse was also teetering on failing. Now, I point that out because there is just one example. I remember, and Silas and I had lots of calls from clients around this time about, is there going to be a bank failure? Is there going to be a banking crisis? Is there going to be this, massive kind of 2008 redo? And
oh yeah, there was a lot of questions about what is FDIC and how does that really work at that time?
Absolutely. And so we got lots of questions of people who were afraid, people who were rushing for the exits, maybe pulling their money out of banks and buying gold or whatever it happened to be. And I point that out to show you that you'll notice nothing else touched on the banking crisis for the rest of the year. It was an idiosyncratic event that occurred because the Fed was raising rates very quickly at that time. And that's what we said to a lot of clients. Look, this doesn't seem to be a systemic issue. It seems to be idiosyncratic among a few banks. And, stay invested, stay in the game. Well, look at what that advice would have really paid off this year, because both the US stock market and the US bond market was up this year. But in the heat of the moment, March, April, when you see all these banks, starting to fail in the headlines, it can be very, very easy to panic and move out of the market. And what we're trying to show on this chart is oftentimes the disconnect that occurs between what you're seeing in headlines and what's actually occurring in the markets. Just a couple more things I'd like to point out. Remember in June, July, right up at the top there, we had the debt ceiling crisis. That was another big round of calls that Silas and I went through. People who said, are they going to pass the debt ceiling? Is the government going to shut down? It was another type of scare moment when people could have easily panicked and gotten out of the market. But it got resolved, it got moved through, and the markets did just fine during June, July. So we put this up here to show clients and to show investors that there's always negative news happening at all times. You turn on the television at any moment in time, there is negative headlines. What we want to draw your attention to is look at how good both stocks and bonds did last year, despite all of these negative headlines. So let's use that as a guide as we go through some of these other things, because we're going to show you some information now on kind of what's going on in the underlying economy and the markets. First, let's turn our attention to something that I think is very powerful to recenter on, which is the odds of the markets. And what you're looking at here is a 60-40 bond portfolio going back to 1970. So we're looking at, 50 plus years here of data. And if you look at that orange line in the middle, anything that falls to the right of that orange line is showing you years in the market when a 60-40 portfolio was positive, had positive return, made you money. And you can see that in each column from 0 to 5%, 5 to 10%, so on and so forth. You can see 2023 in the green in that 15 to 20% column. And then everything to the left of the orange line is showing you when a 60 portfolio had a negative return in a calendar year. And you can see those years listed. And you can see 2022 on the left in the red between that 15 to 20% negative. Now, the first thing to point out here is look at how many more years are stacked on the right side of the line versus the left side of the line. It's not 50-50. It's significantly more tilted towards the positive side than the negative side. And this gets back to the odds of the market. The odds of the market are overwhelmingly stacked in your favor as an investor. In other words, a balanced 60-40 portfolio is going to have positive return way more frequently than it's going to have a negative return. And really all your job as an investor to do is to just survive the negative years so that you can enjoy the positive years. And one of the things that I like to liken this slide to is we often get the question as investment professionals, well, isn't investing in the stock market just like gambling anyway? Well, when we look at a lot of these types of charts, it often shows that around 70% of the time that a 60-40 portfolio tends to be in positive territory versus negative territory. So imagine you're walking into a Las Vegas casino and there's a bunch of slots and you sit down at the slot machine and you start cranking the handle and you discover that every 10 times you crank that handle, 7 out of 10 times that machine pays you, and 3 out of 10 times the machine takes money from you. First of all, those odds do not exist in Vegas. If they were, that's where I'd be right now. The odds are significantly worse for you in Vegas in a slot machine. You are not getting paid 7 out of 10 handle cranks. But when we look at a 60-40 portfolio and we look at the markets, we see that those tend to be the odds that are stacked in your favor. Typically, we see every 6 or 7 times out of those 10 cranks, you're getting paid. There's going to be 3 or 4 times every 10 cranks when you don't get paid, when you lose money. But I draw investors to the question of if that slot machine did exist in a Vegas casino, where every 6 or 7 cranks you're getting paid, every 10 cranks, 6 or 7 of those times you're getting paid, what would your strategy be? Would your strategy be to try and time the 3 out of 10 times you're not getting paid to avoid risk or to avoid the downside? Would you try and guess every 10 which one's going to be? Or would you just accept the 3 out of 10 times as a random, it's going to happen randomly and it's going to be part of playing the game, but overwhelmingly, since the odds are stacked in your favor, you just want to crank that handle as many times as you possibly can. And that's what we're trying to illustrate here to investors, is that if you just stay invested in the market day after day after day after day, that's the equivalent of cranking the handle day after day after day. And that's how you win the game of investing. So let these odds be something that you can use to just sleep a little bit more easily at night, knowing that you may have some negative years, but that over the long term, the odds are going to stack overwhelmingly in your favor. Now, quickly, let's turn to the economy, because the economy and the markets are two very different things. The economy is kind of the underlying machine that is powering a lot of what's happening in the markets. So what we're seeing here is what I like to call the economic health check of the economy. Let's say you go into your doctor's office. What's the first thing they do? They check your vitals. And so they look at a bunch of indicators and they check, they run your readings. And what are they looking for when they check your vitals? They're looking to see if everything is in normal range. Is your blood pressure in normal range? Your cholesterol, your this, your that? Is everything in normal range? It's the things that tend to be outside normal range that's where they start to draw the commentary about what we should be talking about. So what you're looking at here is the economic vital check, so to speak. And what you're seeing down the page is a bunch of indicators that we might look at. And the blue shaded region that you see for each indicator is showing you the normal range that we see those indicators hanging out in. And then the orange little marker is showing you where is the indicator at right now. So if you scan down this, what we want to see is we want to see as many of the orange flags or orange markers within the blue shaded region as possible. And as you just kind of scan down it, you see most of them are in normal range or hanging out very near normal range. The only one that is kind of way outside normal range is the yield spread, that third one down, which is referring to the yield curve being inverted right now. Other than that, things look pretty good when we look at a couple indicators. And I want to draw down to the economic indicators below and just show you the first two, the inflation and unemployment rate. This is what everything is hinging on right now. This is what the central banks around the world are looking at. They're looking at what is the rate of inflation and what is the rate of unemployment. Right now, the rate of inflation that the Fed is looking at is 3.12%. Their target is 2%. So we're not at the target yet. But if we had had this conversation 12 months ago, inflation was not 3.1%. It was a lot higher in that 6, 7, 8% range. So just looking at the last 12 months, we've seen inflation come down significantly. So it's at 3.1. It looks like it's going to still continue to fall from here. Now, unemployment, surprisingly, has really not drifted up all that much. Typically, the way economic theory tends to go is if we raise the interest rate in the economy, that tends to increase the cost of doing business because a lot of the economy runs on credit. So if you increase the cost of credit, all of a sudden, economic activity slows down. And as economic activity slows down, firms tend to hire less or maybe even pull back on their workforce to save on costs. And that leads to unemployment rising. And so in what the Fed's trying to do right now is raise interest rates to slow down the economic machine so that prices can fall and get under control. But they're trying to do that without causing unemployment to skyrocket. And so far, they've been successful at doing that. Uninflation's come down quite far, and unemployment has not moved really all that much. It's been 3.6, 3.8, 3.7, but it hasn't really breached 4%, which is not what we saw in 2007, before we were going into 2008. It was a different situation. So we see the unemployment numbers as a real positive that the Fed might be able to pull off lowering inflation without significantly causing massive unemployment spikes or a lot of people to lose their jobs. So,
So, Roman, I
yeah, go
think
ahead,
the
Silas.
term that we've been hearing for that is that they're trying to help us accomplish this soft landing.
That's right. Yeah, when you hear the word soft landing, that's what they're referring to. They're referring to, can they get inflation down to 2% without causing unemployment to spike or the economy to go into a recession? That's the soft landing. Now, their history at soft landings is not on their side. The Fed has typically, what they've done is they've raised interest rates. The plane's coming in. They want to land it nice and soft on the tarmac. No unemployment spikes, no economic recession, and the plane tends to kind of land down a little bit harder on the tarmac than they thought. And so, but right now it's coming in smooth. So we'll see what happens. Unemployment is the number to watch. That's what everyone's kind of looking at. Because if unemployment starts to creep up and it starts to break 4%, it starts to get to 4.5, 5, somewhere in that range, that's when we may see the Federal Reserve start to put some interest rate cuts on the table. But as long as unemployment's below 4%, we don't think the Fed's going to cut rates um, until that unemployment number kind of breaches that 4% threshold, because they have no incentive to increase or lower interest rates if unemployment is still holding solid and inflation is continuing to drop. So that's the dance right now that we're in. And we will see what happens and how this plays out. Now, let's quickly pivot and just talk about markets. What's been going on in markets? Okay, well, the story is, meanwhile, markets have been great. Despite all the, again, going back to the point we make earlier, that despite all the headlines, all the negative news, all the markets have been doing just fine over the last year. Let's take a look quickly at last quarter. If you look way over on the left-hand side, the blue bar is showing you what happened in the U.S. stock market. The dark gray is what happened in international markets. Emerging markets is in the light gray. Bonds are in brown. Real estate is in orange, and then commodities are in red. And so if you just look at the last quarter, pretty much everything was up except for commodities. If you look over the last 12 months, which is the next column over, everything was up, being led by U.S. equity markets. Take a look over the last 3 years, that middle column. Pretty much everything was positive except for international stocks and emerging markets. But then if you look back over the last 5 years, that fourth column over, everything's positive. And over the last decade, everything's positive except for commodities. What's the message here? The message is, we don't know what the markets are really going to do in a short time frame. 6 months, 12 months, even 24 months. We're not quite sure. But over 3 years, 5 years, 10 years, what we can see is that across the board, most asset classes are in positive territory. And so if your time horizon is longer than 3, 5+ years, we emphasize not really worrying much about the intraday swings or the short-term volatility that might occur, because you're buying the 5-year and 10-year trajectories. And that's what to stay focused on. And so if we buy a diversified portfolio that maybe combines all of those different colors together into a balanced portfolio, we can smoothen out the ride to not be as dramatic. Now, I mentioned that U.S. equity has been leading the way, and you can see that in the last quarter, and then even in the 1 year. I mean, up 26% over the last year. Amazing returns from the U.S. stock market. But there's a catch to that, a big catch, I would say. And it's something that I'm sure a lot of you have been hearing about, which is the Magnificent Seven. If you haven't heard about this, the Magnificent Seven is referring to 7 stocks within the S&P 500 that are really leading the charge in the returns of the U.S. equity markets. So on the top of this chart, what you're seeing is the 7 stocks: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. And then you're seeing the overall S&P 500 way on the right there. The blue bars for each stock is showing you what did the stock do in 2022, so 2 years ago at this point. You can see they were negative across the board. The orange is showing you what did those 7 stocks return last year, 2023, overwhelmingly positive. But my favorite color is the gray. The gray is, what if you took 2022 and 2023 together? What is the return of these 7 stocks? Now, I want to point you to something really powerful. Take a look at Apple. The gray bar is what I'm honing in on. Over the last 2 years, Apple has only delivered you a 10% return. That's because it was down 26% in 2022 and it was up 49% in 2023. Take those 2 years together, 10%. Microsoft, 14%. Look at Google or Alphabet, -3. Amazon, -9. NVIDIA, doing great, up 69% over the last 2 years. Meta, flat, 5%. And look at Tesla, -29%. Now, the Tesla number I really want to hone in on here because what we're showing here is in 2022, Tesla had a -65% return. And then in the next year, it had a 102% return. So how is it down still 29% for the 2 years combined? Well, the reason why is because when you experience a loss in your portfolio by more than 50%, you now have to generate more than 100% return to get back to where you started. And the reason why I bring that up is because in investing and what we do in professional investing, a lot of this game is protecting the downside. Protecting the downside is oftentimes more of an advantageous way to allocate capital than chasing return and going for maximum growth. And so what we're trying to point out here is these 7 stocks have significantly broad ranges of return. Look at NVIDIA, up 239% or down 50%. That's wild swings. What we want to do with professional investing, with long-term investment solutions, we want to allocate capital that dampens the range of outcomes so that we're not either down 50 or up 240, that we're in probably more of a narrow range of outcomes that we're more comfortable with so that we can smoothen out the ride and increase our likelihood of staying invested through all the market turbulence. So what we're pointing out here is right now, there's a lot of inherent risk in the US equity markets because it's being driven by 7 stocks, and those 7 stocks have wide volatility. So what we want to say is for investors who maybe have been riding this train, maybe you've been going all in on tech or US large cap stocks, and you've been really just kind of running this momentum, it may be a good time to consider diversifying your portfolio a bit and having a little bit more rounded of an allocation so you can weather those storms. Now, I want to quickly touch on what's going on in the bond markets before we begin to kind of land our own plane here and wrap things up. The bond side of the equation has been a really tough road the last couple of years. Really, because if you've had bonds in your portfolio, you've seen your bonds go down by 15-20% over the last 24 months, and they've kind of had this slow crawl back up to par. And in some cases, you might not even be back at par. You might still be a little underwater. So a lot of investors who have gone through this journey are sitting there wondering, why am I still in bonds, and should I still be there, or should I be in something different? The answer to the question is, first of all, why did your bonds drop by so much? They dropped because the Fed went on a very aggressive interest rate hiking cycle. Rewind the clocks 12, 18 months ago, inflation was roaring at 7, 8, 9%, and the Fed needed to make a quick change, and so they started to dramatically increase and hike the interest rate environment. That caused current bonds in the market to sell off and become less valuable, and so all investors who had bonds saw their bonds go down. Now, we know that when interest rates go up, bond prices go down, but what happens when interest rates start to come down? The exact opposite occurs, and bond prices shoot back up. And so what this is showing us is it's showing us the trajectory of where bonds might go from here and what the different return profiles look like for bonds in the 3 different outcomes. Outcome number 1 is interest rates do not change at all this year. They stay exactly where they are. In that case, just follow the dotted horizontal line. This is showing you where is the bond market interest rates at right now. This is over the last couple of years. And if you look at that dotted line, it's telling you that we right now are yielding about 4.5% of interest from our bond portfolio. If rates remain unchanged over the next 12 months, we are going to make 4.5% from the interest of the bonds coming into the portfolio if rates stay unchanged. Now, what happens if interest rates go up another 1%, which is not what we're expecting, but it certainly is a possibility. If interest rates go up by 1% from here, our bond prices are going to fall by about 6% because of the sensitivity, something called the duration, the sensitivity of the bond portfolio to those interest rate hikes. So we're going to lose about 6% in price if rates go up by 1%. But that portfolio is generating 4.5% of interest. So we drop by 6%, but then we get 4.5% of interest back. And so we're only negative 1.7% over the next 12 months if interest rates go up. Meaning our downside is quite limited in bonds from here because we have interest coming into the portfolio at 4.5%. So we have a cushion of return. Now, what happens if interest rates fall? Well, instead of dropping by 6%, our bonds now shoot up in value by 6%, plus the 4.5% return that we get from the interest. That would be a 10, almost 11% return from bonds in the next year. That's almost stock market-like returns coming from a bond portfolio if interest rates drop by just 1%. And we think interest rate cuts are... Thank you.
Sorry, our studio audience really, really likes the sound of that.
Everyone should be clapping for that, right? So for those bond investors, you've gone through the pain of seeing your bonds drop because interest rates went up, and then getting a bit of interest and getting kind of that coupon, slowly clawing you back to par. Now interest rates are at this point where we think if interest rates get cut here over the next 12 months, you're going to see a nice boost in your portfolio. You'll get back to par and even shoot out ahead of where you started 18 to 24 months ago. So the message to bond investors is do not bail on your bonds right now because we're in a really great spot if interest rates come down over the next 12 months, which the Fed has announced that they're going to do it 3 times. We'll see if that actually plays out, but the fact that they're announcing interest rate cuts means we think it's more likely than not that they're going to cut interest rates over the next 12 months. And if that's the case, your bonds are going to do just fine for you. You're going to be very, very pleased with your bond returns. Now, I want to quickly touch on a big conversation that we see out there because last year a lot of investors went and ran to CDs and savings accounts and money market accounts. Why? Because they were paying you 5% and they haven't paid you anything over the last decade. So all of a sudden, you can go into an FDIC insured account and get 5% return. Why wouldn't I do that? And so we saw tons of capital leave the markets, leave the stock market, leave the bond market, and flood into cash vehicles like money market accounts, savings accounts, CDs, and so on and so forth. If this is you, this describes behavior that you might have engaged in last year. Here's a couple things to just know about that 5% CD return. When we are talking about investing your capital, investing your money, we are not investing in a vacuum. In other words, there is a rate of return that we need to clear in order for us to be actually making money. That rate of return is called the inflation rate. If you have money and you're now going to put your money to work and invest it, you need to invest it in vehicles that are going to earn more than the inflation rate. The inflation rate is the rate at which prices of goods and services are increasing in the economy. So if the inflation rate is 3% and you're investing your money and you're making 3% in your investments, you are tracking with inflation, which means your purchasing power is staying the same. If you're making more than 3%, you are now actually experiencing what we would call real growth of your money. If inflation is 3% and you're investing and making 2%, you're actually shrinking your purchasing power by 1% per year. So the hurdle rate, the rate that we need to clear, is the inflation rate. Now let's go back to the 5% CD for a second. Over the last 12 months, right now inflation is about 3%. But over the last 12 months, we've seen inflation hover around 4%, somewhere in that range. So if you've been generating a 5% CD return, and inflation over the last year has been about 4 to 5%, that CD actually hasn't really generated a tremendous amount of increase of purchasing power. It maybe has just held it the same, but not so fast, because that 5% return is generating taxable income. And that's where it gets you. A 5% CD is generating interest income that is taxed at your ordinary income taxable rates. So if you're in the highest tax bracket and you're paying 40% income tax rates, your 5% CD return, 40% of that return is going to the IRS. So you're not actually making 5%. You're making 60% of that 5%. And so now when you factor in the after-tax return plus the after-inflation return, what we tend to see is that most clients who have gone to a 5% CD, they've actually lost purchasing power in that decision, because you have not made the amount of return that you really need to be making after taxes to clear the inflation rate. So if that describes behavior that you may have engaged in over the last 12 to 18 months, what we'd like to position is there are other investments out there that can earn significantly more attractive after-tax rates of return that can actually clear what the inflation rate is out there, so you can experience real return on your assets. Municipal bonds will be a huge part of that equation. And if that's something that you think you may want to talk more about, that is absolutely a conversation that Silas can have with you about putting cash to work in a tax efficient and real growth way. Now, I want to briefly touch as we start to kind of wrap up here. We are going into an election year, and I get this question, or I hear this comment all the time from investors where they say, Roman, I think I'm going to wait until after the elections to invest my money. And I understand the tendency. Elections are a time of emotions are running hot, uncertainties are high, and you're worried about the future. And when you're worried about the future, you tend not to make great investment decisions because you don't feel very optimistic about the future. So what we're showing you here is we're showing you the growth of the markets. This is looking at the S&P 500. So this is the US stock market. And the kind of line chart is showing you how the markets have grown really since 1936, so over quite a long period of time here. And down at the bottom of the chart, we're showing you just a brief kind of context of who was president during each of these kind of years and whether they were Republican or Democrat. And what we're really trying, and then also as you can kind of trace that line, we're kind of laying in a lot of negative events that have occurred, whether that was recessions, depressions, wars, whatever it happened to be, scandals, a lot of different stuff that we've layered in to show you one brutally simple insight, which is that the markets are unbelievably resilient to bad news and uncertainty. Markets over the long term go up and to the right. They generate positive return. And when we invest as stock market investors, this is the return trajectory that we're buying into. We're buying into a trajectory that is tracking the earnings and profitability of US companies. which, by the way, U.S. companies are some of the most innovative companies in the world, constantly trying to problem solve and make profits in whatever time frame they find themselves in. And stocks track that earning trajectory. And that's why you see an constantly expanding trajectory, because there's never going to be a moment in time when companies say, okay, that's it. There's all the profits that can be made. There's no more profits that we can make. It's an infinitely expanding line because it's being driven by human innovation. So when we think about stocks over the long term, they tend to track this long-term growth rate that is tied to the rate at which humans are innovating and companies are problem solving. So what does that mean for you as an investor? It means that when we let short-term little decisions like who might be president this year, or who might win Congress this year, or whatever it happens to be, the political environment, when it gets our emotions hot, you'll notice as you look through this line, there's lots of bumps along the way. Lots of bumps. Some are bigger than others. But what do we see? After a bump, the market recovers, and not only does it recover, it then moves to a new high, doesn't it? And then it has another bump, and then it recovers again and moves to a new high, and then it has another bump. And so the point is, you just have to survive the bumps and not panic when the bumps happen. Just accept that they're part of the game, they're part of investing. But over the long term, if you can stay in the game, you'll be the one to benefit from this long-term growth rate trajectory.
Roman, I think the other thing to say is don't mix your money with your politics when you look at it from this perspective.
Absolutely. What's quite amazing, and we have other charts around this, but what's quite amazing is the correlation between when one particular party is in versus another particular party is in charge. There doesn't seem to be any material correlation between market returns and which party is kind of in charge. So we tend to say, don't, as you said, Silas, don't mix your planning with your politics. Use data and numbers and perspective like this to inform your decision making when you're putting capital to work. And so that concludes some of our conversation today. Silas, I'm going to turn it back over to you and let you kind of wrap up here.
Well, Roman, let me just say, bravo. Thank you so much for all the insights from Russell Investments. And again, for making the time to be here with our audience today to share these insights about the market going out of the fourth quarter and as we go into the first quarter of 2024. On that note, if you've been watching along and you go, I'd really like to be able to have my portfolio analyzed compared to some of the metrics that these gentlemen shared today, there's a link right below where you can click for a one-on-one session to review your portfolio. There's also a link below, so if you want to join our live webinar for a live Q&A with Roman and myself, you can also register for that. So that way, again, the content that we went through today, we'd be glad to unpack any questions that you have and additional insights that we can provide to make sure that this information can empower you and your portfolio to greater heights. So on that note, Roman, Happy New Year to you. Thank you so much for being here with us today and looking forward to seeing you at our next session.
Thank you, everyone. Thanks, Silas.
All right, well, we'll sign off. And again, everybody, stay tuned for our next session and click the links below.